Okay, so you've decided to invest in alternative investments. What are the considerations we need to think about before we actually implement our decision? Well, the usual things: risk-return correlation. How's it going to fit into our portfolio? Is it going to give us diversification? Are the returns high? Are the risks too high? Nothing too controversial there. Alternatives, though, perhaps a bit more illiquid than you might be used to from just investing in normal equities and bonds. So really the trade-off there between high return and high liquidity. There could be tax implications depending on whether you want to realise early tax returns, early taxable gains, whether you want those capital gains to come in the source of, or whether you want your returns to come in the source of capital gains or via income, often taxed at different rates. The costs involved, we know that hedge funds have got very expensive fees. It's quite hard actually to look historically and get a really solid idea of the risk and return profile of alternatives, purely because they've not been around for as long as the traditional asset classes. So the data is what it is, and it's there, and we can use it to make decisions, but we don't really have a massive data set at the moment. The traditional way, as we've seen elsewhere in the asset allocation section of the syllabus, is to use mean variance optimization, where we basically use a computer to tell us, based on its own internal machinations and simulations of risk-return characteristics, what the optimal asset allocation is. Now, one of the assumptions underlying MVO is that the returns are normally distributed, and a lot of alternative investments simply do not fit into that box. Okay, lack of liquidity, whether an option's involved or not, whether there's a call or a put option in there, and the potential negative returns of alternatives, they all go some way to distorting the usefulness of traditional mean variance optimization. Okay, not put off yet? Never mind, let's go. Let's try and implement our investment decision to invest in alternatives. Okay, different vehicles then, different ways you can do so. A limited partnership, this is by far the most common situation for private equity investments, whereby the fund manager, the investment firm, will be the general partner. They're the manager of the investment, and each investor becomes a limited partner. So when they contribute capital to the fund, they become a limited partner in the fund itself. That's often used for large investors with a lot of experience, and that tends to fit the profile of private equity investments. For hedge funds, if you don't have so much expertise, maybe you want to invest in a fund of funds. That way you're outsourcing the decision making as to which fund to invest in to an investment manager who has the skill to do so. Again, that might well take the legal form of investing in a limited partnership. We saw in the previous reading about the different specialised strategies that exist for hedge funds. We also saw in the previous reading, and I'll remind you of it now, that funds of funds come with very high costs, because you don't have to just pay the fees of your investment manager, you're paying the fees of the hedge funds and the investments that they then invest your money into. So fees upon fees, different layers of fees with funds of funds. You may be a suitably large and important wealthy person to have a separately managed account. Thereby you give your big chunk of cash to your investment manager, and they don't pool it with all their other clients. They simply deal with it on its own. Because you're a big wealthy person, you can then demand favourable investment terms because of it. Okay, a fund of one is pretty similar. So if you're a large investor, you'll buy a limited partnership, and really the investment firm will only manage your money. So the general partner will be the fund manager, the limited partner will be you, the significant investor. But as we saw on the previous slide, you're getting favourable terms from the investment firm. You're buying in bulk, a bit of economies of scale. So the general partner might not prefer it. So from the fund manager's point of view, they like to charge the standard fee to lots of smaller limited partners. They'd rather do that. They'd rather charge the standard fee on 10 investors than charge a smaller fee on an individual investor, even although the investment might be 10 times the size. UCITS, basically a class of collective investment undertaking. There it is, undertakings for collective investment in transferable securities, things like mutual funds, investment trusts would fit into this category, much more appropriate for smaller investors. They'll buy units in a larger fund, and again, they're outsourcing the skill and the expertise and decision making to the manager of that fund. So it allows smaller investors to have access to alternative investments. They are more regulated. Hedge funds and private equity tend to be far less regulated. Higher returns are therefore on offer, potentially. More regulated, less risk, so lower returns, but of course you get the benefit of a lower risk investment. Okay, now we saw earlier on in the reading that certain investments have got lower liquidity than others. Hedge funds do suffer from a lack of liquidity. Lock-up periods, often a year or more. That's the only time that investors can take money out. That's a redemption from the fund. Same with putting money in. The investment's not available for new investors. There'll be significant penalties if redemptions happen outside of those periods, if indeed they're allowed at all. Private equity have actually got more liquidity risk, private equity investments, as do private credit and real estate and real assets. More liquidity risk than hedge funds. Simply, it's harder to sell on your interest. In the case of private equity, again, the terms and conditions in the investment may prevent you from selling on your investment. In the case of other assets, it's just simply trying to find a buyer might be the problem. Either way, you end up with a loss of liquidity risk. In terms of private equity, you've got closed periods, so the limited partners may decide that, as part of the terms and conditions, we're not going to allow new investors in except at certain points. That's going to dilute their own individual investment. General partners can call up capital periodically. Again, we'll see in a second, we're going to take you through a timeline of a private equity investment. But not only can the limited partners not take money out of the fund, they might be required to put more money in, depending on what the general partner wants to do. Redemption is usually not allowed until the end of the private equity fund, or at least close to the end of the fund. Selling on your own stake in a private equity fund, very limited, very difficult to do. So liquidity problems across the board, really. And if we look at private equity, here's a hypothetical timeline. So the fund starts here at time 0, and we'll say that our limited partner, so this is the limited partner's commitment, $10 million. So they've said to the general partner, yep, I'm willing to put in $10 million when you want it. In the first year, they call up 3 million. In the second year, they call up 4. In the third year, they call up 2. So you'll see there, over the 3-year call down period, so that's the period of time when the general partner can demand funds from the limited partner, they've actually only called up 9 million. So the limited partner was willing to put in 10. Turned out the general partner, the fund manager, only demanded 9. So once that call down period ends, we're in this zone here. And there's nothing the investor can do. They can't put more money in, they can't take more money out. So redemption is not allowed. And then some distributions happen. So this is where the general partner, hopefully if the private equity investment's gone well, it's produced lots of gains and returns, so they begin to distribute some of the funds. So 4 million comes back to the investor just after year 6, 5 million a year later, and at the very end of the fund, 3 million is distributed. So if you know the time value of money, it seems to have gone down well. 9 million put in, and 12 million returned. But what that masks is the lack of liquidity. What happens if in year 4 the investor's got a massive demand for cash? They can't come to this investment to liquidate it because it's not going to happen. So liquidity concerns can mask the benefits of the returns on offer. Okay, so the general partner in that case only called down. You often see the term called up and called down used interchangeably. They only demanded $9 million from the investment. Anytime during that call down period, so 3 years, the capital call, the GP said, give me some more money, please. They don't have to call the entire committed amount. They can call on less. From the limited partner's point of view, that's a bit of a problem for a couple of reasons. Number one, they wanted to invest 10 million. So they've got $1 million sitting there. They couldn't do anything else with it because what if the general partner demanded it? So you've got the opportunity cost of investing that $1 million elsewhere. Also, the management fees, and this is a bit of a nasty trick, the general partner will often charge management fees on the full committed amount, the full $10 million, despite the fact they've not actually demanded or taken the $10 million. So a little bit naughty from the general partner there. The general partner has got just a few tricks that, well, they shouldn't be tricks. They should be clearly identified in the terms and conditions of the investment. But they might decide that some holdings which are really illiquid, well, they're not subject to standard terms. They're not subject to standard redemption terms. Because they're investing in very illiquid investments, they're really going to restrict the ability of the limited partner to get back at them. That's called a side pocket. Just a bit of terminology for you. In terms of the terms and conditions, we've talked about these a few times now. The general partners will like there to be more redemption restrictions. They don't want the limited partners to be able to call down the money or to demand the money back whenever they want. They might want to implement a strategy which requires an illiquid investment, commercial real estate, for example. They want the ability to do that, and if the limited partners are able to take money out whenever they want, the general partner simply would have to disregard that strategy. Also, during adverse market conditions, and we've seen this recently actually, there's been a couple of well-known funds that have had capital flight from them because the market's not doing very well, the fund's not doing very well, so the investors get panicky, they get frightened, and they wholesale withdraw their money from the fund. General partner wants to avoid that. The general partner wants to keep the capital in the fund so that they've got time to recover from these adverse conditions. If the limited partner is able to take money out when things look a little bit rocky, then they will probably do so. Also, leverage is an issue. If the equity fund, the PE fund, or the hedge fund is going to leverage up, they're going to borrow lots of money. Yes, that's going to amplify positive returns. It's also going to amplify negative returns because in the event of a loss, in the event of the fund going pop, it's the creditors who have first claim. That's how leverage works. So leverage is an important consideration for investors to think about. The fees and expenses associated with alts, well, private equity and hedge funds, we saw it in the previous reading, traditionally have a 2 and 20 fee structure. 2% of assets under management, that's regardless of performance, and then 20% of any performance gains, any profits. Might be subject to a hurdle rate, might be subject to clawback as well, but 2 and 20 is the general structure. I mentioned this a second ago, which seems a bit of a nasty trick. Where there's a call down structure, we saw earlier on that the investor had committed 10 million, but the manager only called down 9. Well, they charge the management fee, the 2% on the full 10 million, which seems a little bit nasty, but there you go. Also have a think about the tax implications of your strategies. Okay, so if you expect the alternative to pay short-term gains, well, that might result in short-term taxable income if you don't have a nice tax-efficient wrapper around the investment. Also, if you're a tax-exempt company that's investing, well, often the tax exemption that applies to your individual company only relates to taxable income which is related to the company's purpose. So if you're getting taxable income from investments which can't be squared off with the taxman thinks, do you know what, that's off the side of your usual activities, then that will become taxable. So you've got to have a think about how the taxable income is going to look to the tax authorities when you receive it, and that would apply to both short and long-term investments. Investors, they often do lack the experience to invest in alternatives. That's not a criticism of them. They're just much less commonly used than the traditional asset classes. So intermediaries like funds of funds, we've seen this before. We simply trust our money to an experienced person in that alternative investment category. Funds of funds have got some downsides though. We'll talk about them in a second. So you might, if you've got the resources, if you've got the ability to recruit the skills, you might want to develop your own in-house program. We'll just pop a few reasons up there. If you need highly customized solutions that even funds of funds are not available to implement, higher returns for lower costs, and I think it's lower costs. Remember, funds of funds have got very high costs because of that layering of fees that we see with them. We can identify the best fund managers and recruit them in-house. Okay, so yeah, we're still getting the benefit of that external expertise, but we first bring it in internally. It's going to have an initial cost, but hopefully not as much as the funds of funds fees would have been. And we can perform due diligence a bit easier on our managers because they're in-house. Okay, we know a lot more about them. We've got a bit more control over what they do.